Today's job numbers are a game changer, and that's not just us saying that. We might look back at today's news as a pivot point in the markets and the economy. Of course, we're talking about the US labor market. It added 73,000 jobs in July, but May and June reports see larger than normal downward revisions. This is the Bureau of Labor Statistics. The reports, the revisions were larger than normal, with those changes showing more than 250,000 fewer jobs added to the economy than we once thought. May's job gains were revised down to 19,000 from 144. June's additions were cut to just 14,000 from 147. And by the way, we're going to show you what category experienced the largest displacement. The July jobs report was much weaker than expected and raises the odds of a Fed rate cut in September. That's Oxford economist lead Nancy Van Houten. She also wrote revisions that wiped out nearly all the job gains in May and June. Also, Sarah House, senior economist at Wells Fargo, they said the July jobs report was a dud. Steve Sosnick, chief strategist at Interactive Brokers, he told Yahoo Finance, the 2-month revision is just staggering. It basically wipes out 2 months of what we thought were healthy job gains. Meanwhile, Heather Long, chief economist at Navy Federal Credit Union, she called the job report a game changer, echoing others and saying the labor market now looks a lot weaker than expected. We like that word, game changer. Here's the non-farm payrolls. Now, this is before we refresh the data. So this is what the non-farm payrolls look like before today. In May, 144,000 jobs. In June, 147,000. Well, now we stand May only 19,000, June only 14,000, and then today's figure 73,000. So it's not only that today's number was bad, which it was, but the May and June figures were revised down very, very sharply. Here are the non-farm payroll goods. Again, in May, we lost 4,000 jobs. In June, we gained 6,000. But that was revised down to 13,000 in May, another 13 in June, another 13 this month. Here's non-farm payroll government. This is probably the biggest change. In May, we gained 7,000 jobs, but June looked good, 73,000 jobs. That all changed today. Now, May, minus 50,000. June, that erased that huge gain, only 11,000. And this month, July, we lost 10,000. Here's total private sector jobs. In May, 137,000. In June, 74. That was revised. In May now, 69,000. June, only 3,000. And then today's number, 83,000. So across all categories, we saw a major pullback on what we thought were very good numbers, especially the government sector, which is quite interesting. Here's the labor force participation rate. It's at 62.2. That's not only the lowest low we see on the chart, it's a multi-year low, and that certainly is troubling. Here's the unemployment rate ticking back up to 4.2%. This is multi-year high. Now, by the way, we spoke about this in our Substack newsletter, and if you haven't subscribed already, it's absolutely free, of course, please do, because we put together a really interesting analysis. We see here the Fed funds, they first started cutting rates in July of 2019. Well, we analyzed what the economy looked like in July of 2019 to justify that Fed cut, because we want to answer the question, should the Fed cut rates? It's a very highly contested issue. So this article takes a look at not only the jobs numbers, but personal consumption expenditure, ADP numbers, GDP, 2 different housing numbers as well. We take a snapshot of all of those economic numbers, what they look like when the Fed first cut rates in July of 2019. That was the first rate cut since the financial crisis, by the way, and compared to where we are now. And by the way, the non-farm payroll number during this analysis looked bad. Now it looks very bad. By the way, as stock markets crumble, the VIX, the volatility index, crosses back above 20. That's a pretty big level. We spoke about this in our Substack newsletter as well, and we specifically mentioned that a VIX number around 15, which is where we were just the other day, that's a lot of complacency. It tends to lead to strong markets until we have a spike above that 15 level, and especially above 20. So take a look at that article as well if you have not. We also spoke about the GDP figures and how on the surface this week they look good. But if you look a little bit deeper, digging into the details, we see that was the result of a surge in the imports following a reprieve from tariff fears. Also, we spoke about manufacturing. And on the surface, again, those numbers actually look good. They're 4-month highs. But this article dives into why that may not exactly be the result. By the way, where do we go from here? The blue bars represent the probability the Federal Reserve will not cut interest rates in September. 24 hours ago, we didn't think they were going to cut interest rates. In fact, just 2 days ago, we had the Fed meeting and that strong GDP figure. We had a 52% chance the Fed would not cut rates. Yesterday, PCE, the hot inflation number, that brought us up to 62% the Fed would not cut rates. All that changed today with a very cool non-farm payroll number. Now we see a greater than 50%, really greater than 80% chance the Federal Reserve will cut rates in September. That's how significant it is. And by the way, the probability that the Federal Reserve will cut rates, we haven't seen greater than a 50% chance going back to the beginning of July. So it's a pretty significant pullback we've seen today. Again, if you have not already, please visit our Substack newsletter. We publish several times a week now. Pretty interesting ideas, and I think you'll find it quite interesting as well. We hope this has been helpful. We look forward to seeing you back soon.